Today I want to talk about forced place insurance. And that basically is a situation where you have failed to meet the insurance requirements of your lender from the deed of trust, and they buy insurance I want to say for you, but it's not really for you. And that's kind of one of the things that we'll get into here. But when the lender buys insurance for the property that is securing their lien, for your property that's securing their lien, there's a lot of things that you need to be aware of. Now, most people are never going to run into this. You maintain your own insurance and you make your payments on time, and there's not going to be a problem. And your insurance company is going to be acceptable to the lender. When you purchase property, the lender, of course, is securing that property with a lien, and they can't have the risk of that burning down and their security going away, right? And neither would you, of course. Nobody wants to buy a house and be exposed to that kind of risk. We all want to insure our property, so that's not the problem. And the lender generally is going to allow you to choose your own insurance carrier, okay? And that's essentially within reason. You see this green section right here. I'm going to look at this right here. It says, well, let's start at the top. It says, buyers shall keep improvements now existing hereafter erected on the property insured against loss by fire, hazard, including within the term extended coverage, and any other hazards, including but not limited to earthquakes, floods, etc., for which the lender requires insurance. And so, we all know that. We all know that we have to have our fire insurance when we buy a house, and especially if we're going to finance the house. Lender is going to require that. Then note, they go on to say, the insurance carrier providing the insurance shall be chosen by borrower, subject to lender's right to disapprove the borrower's choice, which right shall not be exercised unreasonably. Now, again, this is one with very little application in my experience. However, very interesting. I had decided to do this video this very week, and I've been thinking about this for the past week, and actually last week I kind of thought, okay, this is one I want to do. And then I had a borrower call me yesterday and said, my insurance company or my mortgage company called me and said my insurance company is disapproved, and they've given me X amount of time before they're going to get insurance for me on my property. What happened? Their insurance carrier rating went down. The entities, organizations that rate insurance companies, they downgraded this insurance company to a B-. And as a result, the lender says, look, we're no longer comfortable with this B- rated insurer, and so we're going to require that you replace it with somebody acceptable. Now, virtually all the known entities out there, the major companies, are going to be acceptable. Most are going to meet the ratings. But this is also probably something related to the fact that he had very inexpensive insurance. And so, you get what you pay for sometimes. So at any rate, now he was scrambling because he had to go and get additional insurance, and the company that was going to provide it for him was like 3 times the premium that he had been paying. Now, he's shopping now as we speak, and I'm sure he'll find better coverage than that, because this was, again, something that was kind of forced onto him in the moment. But the point I'm trying to make here is the lender does have the right to do this. Now, the only time I've seen this in practice is when I had a borrower who thought that the insurance, that the lender was covering her insurance costs. She thought that she was paying that as a part of her monthly payment. And in fact, she wasn't. She wasn't paying the insurance as a part of her monthly mortgage payment. She decided to keep that on her own, but she misconstrued that when it came time for the renewal premiums. And so she got the renewal premiums for her insurance, and she just ignored them. And months went by, and then she got notices from the lender, and she also kind of put that under the same category of something that's been dealt with. This is just stuff they send out, and it's all going to be taken care of. Well, actually the lender had to go ahead and order insurance. And even then, she wasn't aware of it. She was completely unaware of it. And the only way she found out that she was actually now insured by a lender, by an insurance company chosen by the lender, was she went to file a claim. She had a water heater go bad inside her home, and it damaged some of the flooring. So she called the insurance company and said, I want to file a claim. And here's kind of where one of the big issues is. She was not an insured party under that insurance policy. And you'll notice in this deed of trust, this is a copy of the deed of trust that we're looking at right here. The deed of trust specifically absolves the lender from any responsibility of naming you as an insured party when they are forced to get insurance to cover the security interest in the property. They don't have to involve you at all. And in this case, the lender didn't name her as a beneficiary, had no need to do so. She was paying for it. Now, mind you, you're still responsible to pay for that insurance policy, and she was paying for it. It was being added to her mortgage, but she was not a beneficiary. So she goes to file a claim, says, look, I've got water damage from a water heater that busted on my floor, and I want to file a claim. And the insurance company said, you're not a beneficiary of this policy. You're not an insured of this policy, and so you have no standing to file a claim. And of course, the lender is not going to get involved on a little thing like that and file a claim. They're only going to get involved when their security is imperiled. So she was really stuck in that situation. So really do pay attention to that, and note that this is an excerpt from the deed of trust. The deed of trust is a document that's recorded along with your loan, and it's all the things that the lender requires of you with regard to the security interest in that property, with regard to your property, primarily. And you can see this section here. It says, if borrower fails to maintain any of the coverage described above, lender may obtain insurance coverage at lender's option and borrower's expense. So just first of all, know that when you fail to have coverage, lender is going to step in and insure that property, because again, they cannot endure the risk of having that property be destroyed and no proceeds left to pay off the loan. So they are allowed to step in, and it's at your expense. And it says lender is under no obligation, let's look at the yellow part here, lender is under no obligation to purchase any particular type or amount of coverage. Therefore, such coverage shall cover lender, but might or might not protect the borrower's equity in the property, or the contents of the property against any risk, hazard, liability, and might provide greater or lesser coverage that was previously in effect. And again, note also, your contents won't necessarily be protected, and I would imagine probably for the most part aren't protected, because the lender doesn't have an interest in your contents. Your contents aren't what's securing the loan. It's just the physical property itself. And again, because you're not a named insured anyway in many of these cases, you wouldn't be able to file a claim anyway with something with regard to your contents. You also note that liability. A lot of times we have liability insurance that comes with our homeowner's insurance that protects us in the event that something happens to somebody on our property, and maybe we get sued for that. So be very aware of that. Pay attention to that. It's not something to be really worried about. It doesn't happen that often, but pay very close attention to any notices you get with regards to that, because A, you're going to be paying more. B, you probably won't be the insured party, and C, you're exposing yourself to greater and more liability if the lender has to turn around and place their own insurance on your property. So pay attention to those things. Pay attention to notices from your own insurance company. If they get downgraded, those are the sorts of things that could trigger the rejection of your current policy and require you to get a new policy. And the lenders will give you time to do these things. If you're paying attention to notices, it's not like they're going to call you up and give you a day's notice and say, hey, this has happened, and we're putting insurance on this on you tomorrow. And the other thing too is, once you do get your own insurance, like most insurance policies, you can replace it for the one that the lender got and get a prorated refund on that. So so it's not like it's the end of the world if it happens, but it's very bad and potentially very damaging if it goes along for a long time and you're not aware of that until something happens where you have to deal with it. That's it. Thanks so much.